sorry about the delay. I had a little technology issue, but I think it all should be good. You guys all should be able to see. So let's get started. I'm an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRECIPIC. All trades placed by me are placed through T3 Trading Group, and you should carefully consider whether trading is suitable for you in light of your own financial condition. This is my position disclosure. Didn't crush the short side of the market today. I really feel like I ought to have done much better. This was like a pretty obvious down day, to be honest, like almost too obvious. We talked about how the day after a Fed day is very regularly a trend day. We talked about that after hours yesterday. We talked about it again this morning. There was the chance that maybe we wouldn't get that type of price action today because we have seen some muted movements, which maybe is being attributed to this big options expiration tomorrow. Tomorrow's price action is probably going to be super wacky. Yeah, I mean, I just think that today's downside follow-through just makes a whole ton of sense. We gapped down this morning, and it basically was a gap and go. We gapped down by over a percentage point, and we just continued. My initial game plan this morning was actually to look for longs off of support because the market was still gapping. It was gapping down. It was a big gap down, but it was gapping above support. So initially, I wanted to be looking for longs while the market is extended on the small time frames, with the idea that if we get short setups that come in when the market is no longer extended, those would be the better short setups to take, but to be a little bit patient on them, not to necessarily chase the downside. So the long idea obviously failed. We broke support on all of our major indices. 390, this huge level for the SPYs, gone. Qs, 280, this huge level for the Qs, gone. IWM, 178, bit of a level, gone. Actually, IWM came all the way down to its next level, which is this like 174 quarter to 175 area, all intraday today. So today was a complete and utter bloodbath. It makes total sense. The day after a Fed day is often a trend day. Why? Because a lot of fund managers, they're not making decisions on how they want to reposition themselves around the Fed at 2:02 p.m. yesterday or 2:32 p.m. yesterday, right? Like when Powell is speaking right after all the information hits. They want to take their time. They want to research. They want to digest that information, and then the next day they're going to come in with their game plan on how they want to be repositioning themselves around the market based on the new information that came out. The information that came out from the Fed yesterday was not good. It was the revisions. They were just bad across the board, right? And again, this is not new information. We saw it yesterday. I remember I kept saying yesterday that I don't understand how we're not down more. I didn't understand how we weren't basically testing 390 yesterday, given how bad some of that news was. That the unemployment's going to go up more than they expected. Interest rate hikes are going to have to be more than was expected, and that inflation was going to come down like a little bit slower over time than expected. It was pretty much bad. Oh, and the GDP number getting revised down. Pretty much bad across the board. And again, it kind of blew my mind that we weren't trading worse at certain points yesterday. And the only thing, and just weird price action the last couple of days, to be honest, where we had the good news on the CPI, the market sold harder than I would have expected. Selling off from 410 made sense, but selling off that much, to below 400, it was more than I expected. Then yesterday, we have that morning grind up, the news hits. We get hit, but at one point we retraced just about the entire news move. The IWM was even able to fully retrace it, and then obviously we sold off a little bit into the close. But I remember just being like super surprised from like the qualitative macro fundamental standpoint that we weren't trading lower based on that news. And I was just really beginning to attribute a lot of this wackadoo price action to what we saw from that Goldman Sachs note that basically says that they're expecting the market to kind of stay within that range until we get past this huge options expiration tomorrow, and then next week could get a little bit looser and get more of a direction. So that's kind of what I was attributing that to. So coming into today's trading session, we're having this big gap down. It's very clearly not good. We know that the day after a Fed day tends to be a trend day. Well, if we're going to have a trend day today, it could be up, it could be down, but let's face it, based on that news from yesterday, it's probably going to be more likely to be down. But I couldn't help but wonder if there was a chance, for the same reasons that we traded in the kind of weird way we did the last 2 days, that maybe we don't have a crazy sell-off and lose 390. Maybe we are able to, hold in a little bit on the day, and maybe there's some weird price action where we work our way back up, even, again, being attributed primarily to options expiration. And that's just not what happened. The straightforward, simpler thought process that the day after a Fed day is a trend day, and that Fed day was not good, that was not good information, so therefore we should be working our way lower, that more simple thought process is exactly what it was. Now, we still need to properly position ourselves, right? I don't believe, you could have just pressed the short button the second the market opened today. I really don't like that. If you just shorted the second the market opened because you just expected us to die, and especially if you didn't use a stop loss or anything like that, I really don't like that trade because of the degree of extension. Yes, you can have a big gap down and then get immediate downside price action. I have seen that happen before, but usually what you need to have is some sort of corrective price action. You need to correct through time or price so that these smaller time frame charts are not that extended, and then you can get the continuation. So we actually had a couple pretty good long call out. Like the market stunk today. If you were trying to be a buyer, but I feel like we saw these long call outs as good as they possibly could have been, and even with like almost perfect execution on a couple of opening lows, this market just showed you how weak it was. There was no buying happening at all in the spots where we should have been able to get more corrective price action. It turned into time corrections, and time corrections are going to be more bearish or more bullish depending on the direction in which the market was already moving than price corrections. So in other words, being down here and going sideways for 15 minutes as opposed to having this hammer come in, getting a bounce, creating a pivot high, which would maybe a lower high, and then working our way down, this is more bearish, and it was really bad. We had a great tight call out here for like 20 cents risk on the SPYs off of this low, and I was in that trade, and the execution on it was so good that still able to get my risk covered on the trade and everything else. But there was no follow-through on that to the upside at all. Complete and utter buyer strike that was out there. And then what did we get? We got a time correction. The ADMA is beginning to catch up to highs. Honestly, we were so weak that we couldn't bounce back, and we even broke down a little earlier than I would normally expect. I would usually want to see another 5 to 10 minutes of sideways price action, let this ADMA catch up a little bit more, and then we can break down and get basically continuation of this bearish consolidation or bear flag. We didn't even wait. We went sideways here for 10 minutes, and then without even that ADMA fully catching up, we just broke 20 minutes of heavy downside selling. And it's 10 a.m., it's 10:05, we're getting very extended. I'm looking at 4 red bars in a row, and then on the 10:05 bar, that's the second time we called out a long. And I mean, you really can't get any better than that, than like how well we kind of nailed the execution on this, very early in this bar versus lows as it came back through the low of the previous bar was the long call out. And then this was terrible also. Now it's like 10:15 to 10:30. You should be getting more of a 15-minute correction unless the market's going to be super, super weak, which it was. We barely price corrected off of that either. We barely price corrected. I know the IWM gave some better bounces on both of those. Both those call outs, the IWM gave better bounces. But if you're looking at the SPYs here, this bounce is atrocious. We basically go sideways for 30 minutes. The ADMA is catching up to this price action on that time frame, and the next thing you know, we're breaking lows and we're going into a further downside grind. As we're breaking and we're losing 390. And that was another reason why, by the way, to take this long here. was extension into 390 support, looking for that bounce back given the time of day. But it was so hard. It was so hard. And if anybody was flexible enough to be able to capture the short side of the market, which we definitely did not rule out this morning, those trades were there too. But I don't necessarily think that they were easy. I think that you could short the break of the bear pattern here for sure. But I want a little bit more sideways action here. I really want that ADM. If that ADMA doesn't catch up to highs, you definitely have a higher probability of like a shakeout to the downside, where this candle, like this 945 candle, breaks the low of the previous 2 bars, so it suckers you in, but it's still too early because there's too much extension. You don't get the follow through, and it snaps back, and it kind of stops you out on the trade. So if you were really aggressive, the shorts were there. I think we called out a couple of them as well, and we were ready for the potential of downside follow through, because the day after Fed day is often a trend day. And that's pretty much what happened. We eventually stabilized a little bit around 1 o'clock, got a bit boring, tried to stage a little bit of an afternoon rally here, but this rally was like not good. It was not good. I was curious to see if we could close above 390. We didn't. We closed below it. So we lost major key support levels across the board in the market today. It makes this market guilty, right? It really... the uptrend here, I guess technically we're not in a downtrend, and that uptrend was already broken. That uptrend was already broken back here on the 6th, where we kind of went into this range. But now we've broken that range to the downside. So the next question is, do we actually begin to go into a downtrend? I would not say, these 3 bars do not make a downtrend, because we've just been pretty much going straight down. There's no lower highs and lower lows. This high, as a matter of fact, from the CPI day, is actually even a new high by a small amount. So you don't have like a lower low versus this. Sorry, a lower high, a lower high versus the December 1st high. That is now leading to a lower low that creates an actual downtrend. At this point, we just have a break of support. But let's make no mistake about it, the market looks terrible here. Let's see what happens, tomorrow with options expiration. We're coming into the end of the year. There is still some positive seasonality here, but I've been saying this for over a year, and this is why it's so crazy to me that 2022 is over already. Because I remember literally, it feels like yesterday when we were coming into the end of December and the beginning of January, and I was saying the same things. Guys, just because seasonality happens sometimes in the past, and there is some, historical, statistical basis for it, obviously, does not mean that it needs to happen this year. And that was accurate last year. It did not happen. January was a terrible month last year, and this December here, the Santa Claus rally or whatever you're looking for, is not. It's not looking good. It's just not looking good. So we broke some major support levels. SPYs are below support. Qs are below support. IWM is below support. Everything else held equal. You'd rather be short than long this market. The only thing that we want to continue to pay attention to when we're talking about being short versus long just is degrees of extension. And it's always tricky when you go from, and we've seen this happen a lot this calendar year, where we go from extended to the upside to extended to the downside in a really fast period of time, because this is actually a huge downside move in 3 days. In 3 days, we just went from SPY 410 to SPY 388. That's a really big down move on like a percentage basis or an absolute basis. But we're not let's see how extended we actually are. We are $8 extended here, right? We're trading at 388. The ADMA is at 396. Or we're trading at 389. ADMA is at 396.50. So we're not at that point where we're hitting the $10 plus of downside extension, where I feel more confident looking for counter trend trades and actually coming in on the long side of the market. So let's see how we gap tomorrow. If we gap up tomorrow, it's really something that you'd be better off shorting than buying. If we open up flat, it's a little tricky because we're extended to the downside, but not so extended that we still can't go lower and the market is broken. It's just probably still better off being short than long if we open up flat tomorrow, but it's going to be tricky. And if we open up down, depends by how much we open down. If we open up down, we start hitting that $10 worth of extension. If we like gap down to 385 tomorrow, I'm going to think that that's a short-term long. Just again to take advantage of extension into support, because that's our next support level is 385, which is the intraday low of the November CPI day, or when we reported CPI for October and November. So we'll assess that gap obviously in the morning when we're coming up with our game plan, but it's no good. There are a lot of broken charts out there. So the Q's finished down 3.5%. This Apple losing 140 here today. Apple looks terrible. Next support area for Apple is like 134. So rapidly getting to the next support level. Same thing. If Apple's touching 134 tomorrow, I feel like you have to try to the long side, just because you're going from 150 to 134 and 3.5 trading sessions or whatever it is by that point, and you'll be very extended down into it. But again, make no mistake, where if we are looking for these counter trend long setups to come into the marketplace, because of those heavier degrees of extension, they're just that. They're counter trend. That the market is still guilty until it proves its innocence, and we are a long way here technically from this market being able to prove itself after breaking today. You need today to be able to get fully negated by the market. Only if today gets fully negated by the market can you say that we're even neutral again. I wouldn't even say it's bullish. I would say that you're going from bearish to neutral if today's action is able to actually get negated. So again, we're not looking good. Apple, horrible daily candle. Microsoft's actually not terrible coming into the 21 EMA. Amazon is actually not terrible. Amazon is still holding 88. Google looks not good. Google looks real bad, making lower lows here. Netflix had that bad news today, so that certainly didn't help, down to 290. Tesla was like one of the only green stocks in the market today somehow, but that's because it's been getting absolutely destroyed, and there was a little bit of news this morning. Semiconductors, AMD breaking support levels. NVIDIA is actually not bad. NVIDIA actually still looks okay. It's still very much intact. It's still in its equilibrium area. It's still within its channel, its trend, its upper channel here. So NVIDIA is not that bad. XLF, gross, gap below 3450. 3450 was a big level for XLF. Has really kind of been a leader to the downside here yesterday and today for the financials. And energy is just sloppy at this point. This XLE, I think, just looks sloppy. So, yeah, I think that's kind of where we're at. Not a great day for me. I was really having a game plan of, even though it was so like I want to say in hindsight, but not even in hindsight. Even pre-market, it was just and yesterday, it was just so obvious based on this news and based on where we gapped today that today really could be a gap and go to the downside. It just was so obvious. But even with that, not a great day for me. I was trying to take advantage more of kind of downside extension on smaller time frames into daily chart support levels, because for the most part we were above 390 today. We were above 280 at least at one point earlier today, where I was trying to take advantage of buying back some stock in some of these names like an Apple or a Google or an Amazon off that $88, and it just did not work at all. So not a great day for me, to be totally honest with you guys. I've had better, but that's part of the business. We've got our great winning days, we got some down days. All that matters more than anything is going to be how consistent you are with your approach in the long run. So that is all I've got for everyone, and I am happy to take a look at any questions. From Dan H, does the 410 to 390 range on the SPYs look like distribution to you? Okay, so distribution is one of our 4 kind of market periods. Distribution is in this case would be the smart buyers who are already long from October and November selling to the late buyers who are not as smart, right? That's the distribution of stock, and then you kind of get this breakdown. I don't know. I guess so. I guess it could be viewed as distribution on this time frame as you're looking at it. You know, very clearly you've had a range here for a month, and that support level broke, and now you want to see if that leads to a period of decline, which it certainly could. Yeah, sure. It could be. It could be, especially as we're staying below 390. I still, and I was chatting with Pat about it today. Pat just left. He's catching a train back to Massachusetts after coming down for a couple of days. I was talking to Pat about it today. It just like, if we end up going to SPY 320 over the course of the next couple of months, is this just going to be the most obvious bear market move, recession, I feel like, in history? Like, everybody and their grandmother knows the recession is coming, the bear market's coming, and we belong somewhere between SPY 300 and SPY 330. Like, it seems like that's what everybody knows. But if everybody knows that, how are we still even up here? That's kind of one of the conundrums that I've been struggling with. If everybody knows that, if you know that we're going to 320 next year, you should just be sitting short throughout this entire period if you're that type of fund manager, or not buying at all. So yeah, I don't know. Maybe it is just the most obvious recession and bear market ever, and we are just going to work our way down to those prices. But I don't understand why people aren't taking more action now. Though maybe they are. Maybe today was, you know, just the beginning of the break, with the break of our support levels. So that's all I got. That's all I got for you, Dan. From DJ, can you explain how you executed on the 935 SPY trade? Sure. Sure. So it was pretty simple. You can even show the execution dots on this bar if you want, on this chart. So look, we gapped down really big, right? First candle is just going to be a lot of volatility. Okay, fine. You know, price discovery that's occurring. We begin to stabilize a little bit. On the second bar here, with this large degree of extension, my thought process was very simple. We put in a low of 393.22. The previous bar's low was 393.44. I wanted to buy back through the previous 5-minute bar's low versus the low of that bar at that time. So you can see I basically executed that price. I got my one-to-one kick. I was greedy. I didn't sell anything else, and then I got stopped out. And it was a break-even trade, and that's it. So again, here without the execution dots, makes the chart look a little bit cleaner. Just degree of extension. We're buying on the way back up. You know, whenever you're taking these very, very small risk trades, these 20-cent risk trades, you always have a very high probability of getting shaken out of them and then kind of working. But you know, the flip side is you get a phenomenal risk reward if the trade actually works out. I tend to tunnel vision on hammers, so maybe that's a setup I should explore more. Yeah, you really need to have the extension. You are buying on the way up, and in some ways you're anticipating a hammer. I'm anticipating that this candle is going to close the way that it did, actually. And that all couldn't be more correct. The disappointment was the zero price correction that came off of that. I mean, literally, we just got like 7 minutes of time correction. That's how weak this market was, and then they shattered it back down. Seemed that you bought before the hammer had actually formed, not just closed. That's correct. Before it took shape. You usually say to buy on the way up, which I did still do. I did still buy on the way up. It was just very little risk on it, which makes me think it's more ideal to wait for the hammer to form. And that's usually what I do too, DJ. That's usually what I do too. I usually wait for the candle to form. But at certain points in large, you know, same thing with this bottom here that we called out at 10.05, which was also a pretty anemic bounce. It was a very similar thought process. I'm looking at this market selling here. And I remember saying to you guys during the 10 a.m. bar, I remember saying to you guys, man, I would love like an additional 4 minutes. That was it. I said that number, and I said it for a specific reason. 4 minutes of selling, and then I'm going to have to come in and look for a counter trend set up to be able to execute. And it's the same thought process even here. The degree of downside extension, right? At lows, this is 10 a.m. This isn't this isn't 9:30 anymore, where we have downside extension from a gap. This is 10 a.m. and we have been selling off, and the price action is, the low there is 390.33. The ADMA is, wait, hold on, did I just read that right? Yeah, hold on, what's going on? Why am I not reading things right? Oh, never mind. Here it is. All right. The low there is 390.33. The ADMA is at 393.44. We're $3 extended in this So remember, take this into perspective. On a daily chart, when we're like $10 extended on a daily chart, we're like, oh my god, we should be looking for a counter trend trade. This is a 5-minute chart. We are $3 extended on a 5-minute chart. Like, that's very significant. And it's 10 a.m. What do we know about 10 a.m.? We're not quite at the point where the 15-minute chart matters, but we will be very soon. So to be $3 extended to the downside in the SPYs at 10 a.m., let alone how extended we were on the 15-minute, which is going to start mattering more at like 10:15. But the point is that if we can get the 5-minute bounce, we can look for the 15-minute bounce, because the 5-minute bounce should take 15 minutes to occur. If you can get that 5-minute bounce to occur, next thing you know, it's 10:15. Now we can look to see if that 5-minute bounce actually becomes a 15-minute bounce. So this could have been another massive trade here. So I'm watching this sell off very closely. 4 bars down, and I'm like, man, I would love like selling for 4 more minutes. And that, I think I said that at 10:02. Why do I want selling for 4 more minutes? Because I want this bar to close weak, and I want the beginning of this bar to still have some selling to break this bar's low. And then I can buy back through. It's the same trade. I can try to buy back through this bar's low to catch that 5-minute bounce, to then see if that 5-minute bounce can become a 15-minute bounce. That's exactly what I'm looking for there. And man, did they make? I mean, the execution couldn't have been better on the call out. Like, seriously, the follow through was still so disappointing. This 15-minute bounce, can you even call it a bounce? Yeah, we price corrected a little bit, but this is more going sideways than it is bouncing. This is more the ADMA catching up to price than price catching up to the ADMA. Not what you want to see. Just shows you how incredibly weak we are. And then there was no 15-minute correction to speak of, despite it then becoming 10:15. But most of the time, this can be a really good counter trend trade for you from an execution perspective to be able to kind of get that. It's better for the bar that you're trading back through to be of higher volume and larger. You usually want volume to just be steadily increasing on the way down. You don't. This bar is going to be too early, almost the 10:05 bar, to know what that volume is going to be looking like. But you certainly want to see this like upward increase in volume over the course of the last several bars as it's breaking down and getting extended. Ideally, you would want this to be even bigger, which it wasn't. And then kind of there's the buyback on that. Let me see. Usually say to buy on the way up. Okay, I think I got through your question. Yeah, for sure. And again, these are different types of trades, right? Like I'm talking about one type of trade here where I'm really trying to take advantage of execution and of extension, and that's how I want to execute it. But there's another trade, a different trade where you're waiting for that hammer to actually close, for the volume to be there, the extension to be there, and the bar has just closed or it's about to close. Then you can buy versus the low of the tail, and look for a similar type of upside corrective action. What's going on with this GH down 46%? No idea. This still feels very different to me than 2008. This is more. I still feel like this is more of an amalgamation of the 1970s price action with the .com price action. No problem, Bennett. Jay Powell has given some confusing signals. Could be a factor. Yeah. Tomorrow's going to be an interesting day. I'm actually not looking forward to tomorrow's trading session. I don't like these option expiration days to begin with, personally, for my approach, for the way that I trade. I don't like how the price action in the close becomes so nutty, and it's almost become every Friday that it's like that. But tomorrow is going to be especially special as far as the amount of expiration that's happening. What was it, 3.9? I don't remember what the number was. It's a really, really big number. Cool. Anybody else? Okay. All right. Well, I guess we can wrap it up. I don't have access to the YouTube right now, so if anybody has posted a question on YouTube and I'm not getting to you, I apologize. Pat usually gives them to me, and Pat had to go catch a train. But if you are watching on YouTube, even if I'm not answering your question, smash on the like button anyway. Still trying to build that out. And appreciate it, guys. I will see you all tomorrow. Have a fantastic night.